Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Last week, we looked at local equity markets and how their fortunes might stack up for 2018. Today, we turn to the international credit and equity markets and look at how they would have performed over the 2017 period, as well as what could be in store for the year ahead. 2017 was indeed an impressive year for equity markets across the globe. In fact, some analysts would have joked that you could have thrown a dart at any point on the map and made money very easily in 2017. Taking a look at the performance of the different major regions, the US market, as measured by the S&P 500, would have advanced some 19.4% for the 2017 period on the heels of higher investor and consumer confidence and some stability in terms of economic growth. And this was on the heels of a 9.5% advance in 2016. Latin America also posted a commendable advance of around 20.8% overall, with Chile being one of the exceptional performers, with the market advancing around 46% in US dollar terms, while Brazil, the largest equity market in Latin America, would have advanced some 25% as well. And this would have followed a 2016 performance of just around 28% in the Latin America markets. And turning to Asia, after relatively lackluster 2016 of around 2.9% in terms of stock price advances, 2017 was indeed quite impressive, with an almost 39% increase in stock prices. And this would have come with the support of South Korea, whose market advanced around 37%, while the Indian equity market also advanced some 36%. Overall, one of the driving themes in 2017 was improved investor confidence and the story of continued global growth. And this we expect will continue to roll over into the year ahead. Turning to fixed income markets, there was also commendable performance for both investment grade and high yield bonds, which posted total returns of around 7.5% and 9.7% respectively in the year 2017. Now, this was despite 4 interest rate hikes between the period December 2016 to December 2017, and the beginning of the tightening or the unwinding of the US Federal Reserve's balance sheet of around $4.5 trillion US dollars, which is expected to reduce liquidity. Nonetheless, the market was again very confident, and there appears to be an insatiable search for yield for both institutional and individual investors across the globe. And to put this into some context, let's take a look at the Trinidad and Tobago US dollar bond offerings that are available to investors. And looking at the 4.5% bond, US dollar bond due in 2026, for example, at December 2016, investors were demanding a return or an annual return of just around 4.7% for this particular bond. At the end of 2017, however, despite 3 US interest rate increases and a credit rating downgrade for the Trinidad and Tobago economy by S&P from A- to BBB+, and by Moody's from Baa1 to from Baa3 to Baa1, the yield demanded by investors on the 2026 bond would have fallen actually from 4.7% to 4.1%. So a lot of chase for yield, and this would have been manifested in higher bond prices and lower required rates of return or yields from investors. So what's in store for 2018? Well, having distilled a lot of the analysts' views and perspectives out there, there are a couple overarching themes. One is that energy commodity prices stability or increasing is viewed as an overall positive for both equity and bond markets. And this would be viewed as supportive to a lot of export-led emerging market countries. And it also signals increased economic activity and growth for energy importing countries such as China and the US and India, for example. Speaking of growth, global growth is expected to be somewhere in the vicinity of 3% as an estimate in 2018, which is also viewed as supportive for both equity and bond markets in the year ahead. In terms of downside risk, well, political risk and policy risk remains, where midterm elections, for example, in November in the US, could bring some instability or create some uncertainty to both equity and fixed income markets, as well as elections in Brazil in October, for example. And finally, as we spoke about a couple of minutes ago, U.S. monetary policy could also invoke some instability or uncertainty in equity and fixed income markets as well, with 3 to 4 interest rate hikes projected in the year ahead. The first being expected or projected in March of this year, and there's currently an 88% probability of a 25 basis point increase in the coming 3 months or so. So how does our major asset classes stack up now? Well, as we mentioned last week, for the local equity space, there's a projected decline of just around 2 to 9%, and stock selection remains key, with just maybe 2 or 3 stocks in the market having a buy rating from BORS at this point in time. Internationally, in the bond market, it may make sense to stay short, to maintain short-term exposure and be selective in terms of picking and choosing your particular investments. And with respect to international equities, there is cautious optimism. The general sentiment is that the markets will be up or should be up, though not to the same magnitude as was experienced in 2017, and that some focus should remain on countries or regions with strong economic fundamentals, good growth, consumer demand, etc. So what are some of the overall investment themes that investors should consider for the year ahead? Well, one of the main tenets of BORS's investment themes remains adding value through diversification. That is, not putting all your eggs in one basket, whether it be a handful of securities or a particular asset class. Secondly, speaking of asset classes, you need to tailor your asset classes in the coming year, whereby you focus on those sectors or asset classes which have a more positive expected performance and reduce your exposure to those with less. Rebalancing, and this leads to more active portfolio management, is probably going to be a good idea in the year ahead also, where after quite a rewarding 2017, it might make sense to take some of your gains off the table in asset classes that would have performed really well and reallocate your portfolio to make sure that it's in line with your long-term risk exposures. And finally, maintaining that long-term approach is also key for a prudent and measured approach to your investing in international and local financial markets. That's it for this week's edition. For more information on how to better position your portfolio, give us a call at 226-8773, visit our website at borsinvestment.com, or email us at invest@borsfinancial.com. Have yourselves a wonderful investing week. This has been the BORS Report.